Hi, everyone. Welcome. I'm here with Don, and my name is David Jaffe, and we're going to discuss options trading and trading in general, our overall thoughts on the market. And Don, you have a YouTube channel. Do you want to introduce yourself briefly?
Yeah, everybody knows me as what's up, what's up. So Don from the Don Front Show. To keep it simple, just a price action trader. No indicators, not chasing news, just simply price action in the charts.
And my name is David Jaffe. My YouTube channel is youtube.com/BestStockStrategy. And I sell options and I also look at price action.
Awesome. Man, real quick, you said you attacked this and you tried to get a few percent a month, right?
Yeah, around 3% a month.
I just want to hit on that in my group because a lot of people think the stock market is 2020, where they buy a stock and if it's not up 20, 30% that day, it's broken. And I just want to reiterate to people that that's actually still awesome. The S&P is still on average 7%. And people out here just thinking they're going to blow the doors off that, or what's wrong with the market if they're not. So just wanted to hear that out loud. Again, you're still out here chasing 3% a month, still doing awesome. And I think that as the stock market returns back to reality, I think those are the conversations that'll really help people out.
Well, I'm not a sucker. I really enjoy making money. I went into investment banking and partly because one, I didn't respect myself and I didn't care about managing directors, treating me poorly, I guess. But also I really like money. I think that the reason why I target that amount is because it really hurts to lose money. I think that there have been a few studies that said that losses hurt 4 times more than the gains feel good. And I would rather earn consistent income and be able to sleep at night without having a lot of stress and without having significant portfolio volatility, as opposed to trying to hit home runs and striking out. Because there's a big difference between using a strategy that has a high probability of profit versus just YOLOing and buying a stock, hoping that it goes up, and just kind of gambling and walking into a casino. Because we all know that if you're walking into a casino, the people who are virtually guaranteed to make money are the actual casino, and the gamblers are the ones who subsidize the free drinks and the food. And that's why I want to turn myself into a casino, and I want to turn myself into an insurance company.
Yeah, you want to be the house.
Exactly.
So what I say, and I've actually had to say quite a bit lately, is on my style of trading, because I'm not just selling, we're also buying. But I keep risk management small, be hyper aware of your allocation. The home runs do come. Chasing the home runs is where trouble comes. But so in your world where you're selling puts, because best case scenario, it just goes up, you keep the premium. What's a home run look like in your book? Or are you just avoiding all the volatility regardless?
That's a good question. I guess a home run is when the VIX is really high and then I'm collecting a lot of premium. Like last week, intraday, I think the VIX hit 35 and now it dropped all the way down to below 20 today. Right now, I think it's December 10th. But I think that really a home run is collecting a lot of premium on a position that doesn't use a lot of buying power, that's pretty far out of the money, and just keeping that premium and holding the trade for 1 or 2 weeks and realizing a 60% profit. I think that I'm okay with buying options, with buying a call, but I don't usually do it. Instead, what I do is I will sell, I will buy an at the money put option, and then I will sell an in the money put option, and then I'll sell short dated calls against it. Because really the benefit of buying a call option is you get to participate in the upside, right? Mm-hmm. The problem is that you're paying money, you're paying extrinsic premium for that, and the stock has to go up more than the strike plus the premium you paid in order for you to profit from it. What I would like to do is buy an at the money put, which protects my downside, and then sell an in the money put, let's say on something like PayPal, which I believe is oversold. I would, let's say, buy a 190 put. I would sell a 250, and I would sell, and I would choose an expiration on that spread that's 2 to 3 months out, And then I would sell short dated calls against it with a strike of about like 210, and then wait for that to expire, and then 215, 220, et cetera, depending upon the current market price. And therefore I can participate in the upside of that stock as well. So, I've made some money. I've made a lot of money by doing that. So I guess that would be a home run, but I really only do that 5% of my trades. I only do that if I think that a stock is really oversold. So I would say that the bread and butter is really like selling puts and calls.
And you sell those on blue chip, right? Just the good stuff.
I just honestly, like, I don't think that there's any informational advantage, and I think that that's something that we're brainwashed with, right? Like, from a young age, we're told study hard, like bust your ass, work really hard, and it'll pay dividends. But the reality is that in the stock market, you have tens of billions, hundreds of billions of dollars chasing like a little bit of money. And if you think that by reading 10Ks or 10Qs or going on Reddit and reading Wall Street Bets, that you're gonna know more than like institutional investors or hedge fund managers, like, yeah, of course, like occasionally you'll win, like for sure. Like GameStop, a lot of people lost money, a lot of hedge fund managers lost money, but why spend your time doing that when you can just look at price action and just assume that everything is priced in? And that's why I look at large cap stocks, because the larger the market cap, the more liquid the market, the greater the probability is that there is no informational edge and no informational advantage.
I wish we would have had this conversation a long time ago. That's stuff I love. That's what I say, like to a T. And to be clear, it's the first time we're actually talking. But I will use this as a time to transition into a crap trade that I personally got into. I got suckered in, which selling puts is never really supposed to be the home run. And but I got suckered into a low cap crap stock. Wall Street Bets was hyping it up. Now I've never been on Reddit, but they were talking about it, sent the premium through the roof, and it was $5 puts. And so I was selling them for 45 cents. Now on Ford, I'm selling $20 puts for 17. Like there was just a huge difference. It was just too easy, too good to be true. I did it for a couple weeks, but then eventually I did get assigned. And like any other pump and dump, it just continues to bleed off. So collected some awesome premium. I'm in by no means big. I never put my account out there to just, some people just hang themselves by their own decisions like that. But I wanted to get your take on it, because I'm probably about to just buy myself out of the position or just lose it. I'm tired of even seeing it in my account. I collected some premium, it went south, so what? But what are your thoughts on that?
All right. So first off, if you kind of extrapolate the amount of premium that you receive based upon the strike price, like collecting almost 10%, that would be, that's a lot. It would be like, if you sold like a 1,000 strike on, now was the stock trading at $5 or did you sell a $5 strike? What was the stock trading at?
Like 550. It was right around there.
Okay, so it was like 10% below its current market. So that would be like if you sold a 900 put on Tesla and then you collected, like $80 of premium. That's like astronomical, So that would be like a big red flag to me. But then I would think, okay, well, some things are too good to be true. Like even with GameStop, when it was going crazy, when GameStop was trading at like 400, you could sell like the 900 call option and pick up like $12 or something. Now the brokers, they changed their margin requirements, so it pretty much made it so no one was trading it because you couldn't margin or use Regulation T. But there are some occasional things. What I would do is I would ask myself, do I believe in this company long term? Mm-hmm. And do you? Okay, so if you think that it's just kind of like a crap company, then I would pretty much try to get rid of it ASAP. If you believe that next week it's going to crash, then I would sell the shares like ASAP on Monday. If you think that it might like trend sideways or potentially even go up slightly, then I would like probably sell 1 week out expiration calls, either at the money if you want to collect the most premium, or maybe like 5 or 10% above the current market price. That way, because hey, if you sold puts on it and collected like almost 10%, like 8%, then the call premium is also pretty rich. But if you also want to get rid of it, then I'm sure you can collect a decent amount of money by selling at the money, or maybe like 5% above the current market price with a 1 week expiration, and then just wait for it to hit that. Or if it keeps falling, then you would just close it out.
Yeah. And then what you said right before this, though, really, really resonated. Something I say a lot. But you said close it and free up that mental space. How did you word that? That was just the best.
Yeah. So I think it's really important that, okay, every single time you have a losing position, it adds like a little bit of stress because you get anxious. Like, you work really hard for your money, so you have to make sure that your money is also working hard for you. But your money's not working hard for you when it's causing you stress, when it's tied up in like a really crappy underlying. So as much as people want to create YouTube videos and profess that they have like secret knowledge that this stock is going to 10x over the next few days, like, nobody knows the future. We don't know that. And if a stock is causing you stress, unless you believe in it long term, unless it has like a strong brand, or unless like you wouldn't mind owning it long term, then I would definitely think that it's worthwhile to rid yourself of that headache and get rid of that toxic position, because you'll make that money back elsewhere. Now, the problem is that if you've traded too large and you've kind of like YOLO'd your account, then you don't really have much of a choice. And that, every tick in the underlying stock is going to cause you either a lot of elation if it goes up, or a lot of stress if it goes down. And that's not, I don't think that is a long-term consistent, or like, that's not a strategy that's geared towards longevity. It's not something, it's not how you want to trade long term.
Yeah, it's not bringing in the income.
Yeah, it doesn't have longevity, because if you're working at a job and every time you clock in, you just hate working there. It's like super stressful. It just, the anxiety and the stress, it just makes you want to like quit. And then when you throw in and you add on like the potential losses from a position, that's why I always think it's best to try to mitigate your portfolio volatility. Now, I think, and get rid of toxic positions. Now, I do think it's okay to kind of like allocate 5 or 10% of your account for home runs. And additionally, I do definitely empathize with like new traders or people who have relatively small accounts, because I'm sure some people who are watching this are thinking, well, I only have $1,000 in my account. 3% is $30 a month. That doesn't move the needle at all. The reality is that you're not always going to have $1,000. And I think it's really important for you to learn good habits and to establish like a lot of discipline. And by doing that, once you have a larger account, you'll be able to grow that account consistently. So definitely, like, being disciplined and patient is way better than than trying to hit home runs. Because there definitely are some people who turn like $10,000 into like 200,000, but a lot of those people end up losing their money. And if they don't change their strategy and they try to do the same thing, then they usually end up losing money, especially like doing things like day trading or buying options or things like that, which have a negative probability of profit.
I've seen that a lot, actually, just over the years and chats that I've been in, is people think, I'll just YOLO this one time. I'll get just a little bit ahead and then I'll trade like I should. And then they say that, and then they either A, blow their account, or B, they do hit that one trade, that one good one, nothing changes. And then you can just watch their P&L look like a pump and dump, because it comes right back down on the next one.
Mm-hmm.
Yeah, I hate seeing it.
I'm not built like that. I don't like the stress. I don't want to. Now maybe if I was like younger, if I was like in my early 20s, then I would be more immune to the stress and be like, okay, whatever. And but now that I'm in my 30s, I don't want to do it, because when you're in your 20s, like, you get away with a lot of stuff. You can go out drinking, you can come home at 4 a.m, you can go to work the next day, and like you're fine. And you have 50 years where you can earn money after that. But as you get older, like, you start wanting to not lose money, and you don't want to deal with the volatility.
Yeah, I agree. So So let's talk about the markets. What do you think? I personally thought we were going to see a crash next year. Not that I'm buying puts now or anything like that. That's kind of what I was thinking, like a market reset. I thought that fit the narrative. But then all the YouTubers started saying crash, and then that makes me wonder if that's ever going to happen. Because I don't like one indicator I guess I have is that if all the YouTubers are saying it, it's probably wrong. Like
Yeah, it's contrary. Well, okay, I think all right, so 2 weeks ago, VIX hit 35. So VIX is like a measure of fear in like the S&P, right? So generally speaking, when the VIX is really high, like people are really scared, and then they're not really like buying stocks, or they are buying put options, which is increasing it's increasing the price of options. However, this past week the market was up 4 out of 5 days, and okay, it was up a lot as well. Like it was up 3 straight days. And then I think it was down on Thursday, and then it was up today. And VIX, which measures fear, it closed below 20. I am not good at predicting like what's going to happen, in like the long term. But it seems like unless bad news comes out regarding like the virus and stuff, then I kind of feel like December might be strong. I mean, I don't know, but I do see some opportunities in individual stocks, though, which I think is which I can speak to. Like the market, who the hell knows? Like, one piece of bad news on the weekend, and then because we do know that the S&P right now is very volatile. I mean, it's gone 2 weeks ago, it fell a lot, and then this past week it was up a lot. But I do think that there are some really good opportunities right now. Like you have Tesla trading. I think earlier today it was like below 1,000. And I think it actually closed up. But, Tesla is about 20% off its highs. So I would sell like a put with a strike price of about 600, or if you wanted to be like more aggressive, you can sell like a 700. And then if you wanted to turn that into a spread to make sure it was more efficient, then you could sell like the 700 and buy like the 650. I also really like PayPal, because I think that a few months ago, PayPal was trading close to $310, and then it hit a low of like 179, and then this past week it traded all the way up to like 197, and now it's trading, I think, around like 187. So I think that that's pretty good. Like you can be pretty aggressive with your strikes on PayPal, because for the past month it's pretty much traded between like 180 and 190. So it looks like it's forming some support there. So if you wanted to sell something as aggressive as like the 170 put, then that would be a decent trade. I also think Amazon is okay, because I believe it's trading below 3,500 right now. So you could sell like the 27, 2,800, or unless you have like portfolio margin, then you could go further out of the money and sell like the 25 and not use up a lot of buying power. On the call side, maybe you wanted to sell some calls on like Apple, which has gone up a lot. Microsoft, which has also gone up a lot. So yeah, I think there are good opportunities in individual stocks. I don't usually sell options in the market. I usually choose specific underlyings, because there's more available premium in those underlyings than there is when you sell like the SPY or SPX.
Yeah, for sure. So you're actually listing off every ticker that I'm in. Those are like my bread and butter tickers, by the way. But so I want to ask a couple questions. Why so far out of the money on like you said, Tesla, $600-700? Like, I mean, I think at 800, I say this jokingly, unless Elon goes in to a factory and is an active shooter himself, like I just don't see Tesla even getting that low. So why do you choose that far out of the money? And then Amazon, you keep saying it's below 3,500. Do you set price targets first and then think something's cheap? Do you value things first and then decide what's cheap, or is that more price action for you as well? Because we know Amazon was very horizontal for a while, right there at that 2,900, $3,000 mark to, it was what, 35, and it popped to 37 for a bit, but it just traded sideways forever.
Yeah, Amazon was trading between like 3,250 and like 3,550 for about like 2 or 3 months, and then it popped up, and now it's actually like falling back in that range. Okay, so there are a few questions there. Why do I go so far out of the money? I think it's because I don't want to worry or have any stress about trades. And to use PayPal as an example, what happens if I'm wrong? Like I want to be wrong and still be able to make money. So PayPal a few months ago was trading at 300, and then when it fell down to 260, I actually sold like the 215 put option. And then if I was more aggressive, and I would say that the likelihood that I'm going to make money in that 215 by rolling it and things like that is probably going to be about like 70 or 80%. But if I was in there at a 240, I would feel much less confident. Maybe I would make, I mean, because right now with PayPal between 180 and 190, I feel pretty confident that I can roll the position down from 215 to like 210 to 205 just with time. But if I'm in there like at 240, it's going to be much harder. And the way that so I know that I'm leaving some money on the table, but I'm also protecting myself against the downside risk. And then regarding PayPal, why like a similar thing with that, I do think that PayPal is heavily a momentum stock, and I do think that Elon Musk is kind of like he's a brilliant guy. My wife actually has a really crush on him.
You're saying PayPal. We're talking about Tesla.
Sorry, I meant Tesla.
Okay.
Yeah. So my wife has a big crush on Elon Musk, but at the same time, I do think that Tesla is kind of like a little bit of like a cheerleader stock. Like Elon Musk is kind of like he's like a celebrity CEO who happens to probably be one of the most brilliant people in the world, but he knows how to like manipulate the media. You know, like he would like send shorts to some of the hedge fund managers, and he would like mess with the SEC, which, I mean, I don't know why he would do that. He like got himself into a lawsuit. You know, like Tesla has amazing lawyers, but still, like he like provokes people. And the fact that Tesla has gone up so much, I don't think that it's impossible that it's going to fall below like 600 if the market like corrects. So because I remember when I was selling calls on Tesla on, I think it was January 7th and January 8th of 2021, Tesla went up about 18% in those 2 days. So if it goes up, and remember, the market has a tendency to take the escalator up and the elevator down. So if it can go up like 20%, 18% in 2 days, I think it can drop like 30% in like 2 days. So I just want to be careful with Tesla, especially because there's a decent amount of premium there. And then regarding how I choose my strikes, I choose the highest strike that I don't think is going to get challenged. And then I look at the premium and I ask myself if I think it's worthwhile to make this trade given the amount of premium that I can receive. So if I wanted to like sell like the 650 put on Tesla, and then I saw that it was trading for like $2, then I would see like, okay, then I would look at how much buying power it would reduce my account by. And if the buying power wasn't that high, then I'd be like, okay, no problem, make that trade.
Okay. So you're pricing in the risk of a just worst case scenario first. And then if you do get assigned that worst case scenario, you're probably hoping is already the bottom, if not completely avoided in general.
Right. Or even if we run into a situation like March 2020, the short put will be so far away from the current market price that the stock level already, like, now again, like I said, with Tesla, I would be okay with selling like the 170 or maybe even the 175. That's less than, or sorry, with PayPal, I would be okay with selling the 170 or 175. That's less than 10% away from the current market price. But with something like Tesla, which is like a high flyer and which is very volatile, that I would probably feel the most comfortable selling no higher than like a 700. And the reason is that if the market corrects with Tesla, if it falls down to like 800, it'll probably take about like at least like 3 or 4 days to fall down to 800. And I'll then have the ample amount of time. And by that time, volatility will have already spiked. And I'll easily be able to roll that position from my original strike, whether it be 700 all the way down to like 550. So I always want to make sure that I build in that safety net. And when the VIX is low, you really have to be careful of selling options, because there have been numerous times over the past few months. In September it happened, and even just like 2 weeks ago, where the VIX was up like 54% in one day. If you're selling options when the VIX is low, then when the VIX spikes up, you're going to find yourself being low on buying power. and then defending your existing positions, even if those positions aren't even close to being in the money, they're going to show you a loss because of the spike in volatility.
Yeah. Okay. That definitely makes sense there. Yeah, because I got joked, made fun of a little bit in my chat because I had I forget the scenario. I bought puts on Amazon, but something happened in volatility. I forget the exact scenario, but my puts went up along with the Amazon ticker.
But yeah, it must have been the pop in volatility, right?
Yeah. Vegas sent it up, and they were making fun of me that I just couldn't lose. And but yeah, it's just those scenarios to the downside where you collected $1 premium and it is now $5 something, because things just went off the charts. Yeah, so you want to really avoid those scenarios. I see what you're saying now. What's another good one I have for you? How are you on I guess weeklies, monthlies? Like how far? Because I like weeklies because I like to adjust my strike as the price moves. Where so I'm grabbing 4 weeklies versus someone selling 1 monthly.
Yeah, I'm cool with that. I think that from an expiration perspective, I tend to go anywhere from like 2 weeks out to like 7 weeks out. It really depends upon the opportunity. I think that weeklies are fine, especially if you're trading like large cap underlines, which are really deep markets and have a lot of liquidity. I've never noticed any difference in fills between trading an Amazon weekly or a Facebook weekly versus a monthly.
Okay. What's your you mentioned a spread earlier and then buying call or selling calls against it?
Yeah.
What's your go-to? Is that your go-to option strategy or naked
No,
puts or?
Yeah, usually I sell naked puts because I'm using portfolio margin. If I was using regulation T, I'd probably use like more spreads. And then the structure that I said before, where you buy an at the money put and then you sell an in the money put and then you sell short dated calls against it, which allows you to participate in the upside of the stock. I do that maybe like 5% of the time. And you can also do that on the downside as well. Like you can buy an at the money call and then sell an in the money call, and then you can sell like short dated puts against that as well.
Interesting. I personally don't think I've done that one. I know in the options world, there's just options gymnastics to do all sorts of things. A lot of mine are like I'll buy. I do a lot of buying as well. But when it pops up, instead of closing it, I'll turn it into a spread. And that way, if it continues to go up, I'm good. If we get that pullback, obviously, I just locked in that profits.
Right. Yeah. I think that's smart.
That's a majority of. I'd say most of my plays are that. If I can get there, that's how I'm looking to almost exit and just get that cherry on top. If it's just a spread, ride that out. But you talked about earlier in this video, you wanted to collect 60% of that position. When are you buying your positions back to close them?
Yeah, about like anywhere from 50 to 70% of the original premium.
Why not just rock it out? You're so far out of the money. Why not just let it go another week?
Yeah, sometimes I do that. I think it comes down to, let's say like if volatility is low, then I'm concerned that there might be like a pop involved. Then I want to like close out pretty much all of my winners, because when the VIX is trading at like 15, why risk having the next week like VIX trade up to 30 and then kicking yourself and then additionally it comes down to like deploying your capital well. Let's say I put on a trade and I collect $2 and the expiration is, let's say, 30 days out, and then in 1 week I'm able to collect 50% of that, so I collect $1. And why do I want to wait an extra 23 days to pick up the incremental 50% when I've already collected that 50% in 7 days? It just makes more sense to close it out and redeploy that capital.
Yeah, keep the easy money and go after some other low-hanging fruit.
Yeah, exactly.
That makes sense. Yeah, mine with the weeklies, I buy them back just to avoid any weird gamma situations on Friday. But mine, since they're out of the money, like Friday, they're worthless. I'm trying to buy them back for $1 or $2, and call it good. I'd rather not risk that. Like, you're literally risking something happening over $1. Like, at that point, it's time to just lock it and sell the following week. For me
So
personally.
you'll put in like a buy to close order for like 1 or 2 cents, and
Yeah.
then just wait for it to fill. Okay, yeah, I mean that's really smart.
Yeah, but I mean, the ones I'm going crazy on are Apple is a little bit more than that, because even on Friday they're still up there a little bit. So that's more like 20 cents on Apple, except today. I don't personally roll, so we can talk about this. And maybe I'm just broken. I don't know why I don't roll contracts, but I had sold the 175s on Apple, and I got $1.60 for it, expiring today. I ended up closing today for 220, which I'm glad I did, because we just kept going. I don't even know what they ended at, but and Steve, someone in my group said, "Why didn't you just roll that?" And I 100% get that I probably could, and probably would have been a good trade. I have a mental block with actually rolling positions. I like to just physically, even if I'm going to open the next week up instantly, I still physically close it and then open the next one up.
To be honest, I don't think that that's bad. So from your position with Apple, you lost like 50 cents on it.
Mm.
It's like nothing. I mean, seriously, I don't think that's bad. Like I'm actually, maybe it's like an ego thing. I don't know, but so I'm short like a 190 or a 195 call option on Apple, and I think it expires like next week or maybe the following week. And I'm actually like kind of concerned about that. And I could close it out now for maybe like 20 or 25 cents more than I sold it for.
Mm-hmm.
So why I probably should have done that. Like, why do I want to hassle myself or even think about it for 20 or 30 bucks when like literally like 85-90% of my trades don't even get challenged, and I just set it and forget it. So maybe it's like a character deficiency. I don't know, but I don't think it's like a bad thing for what you did. Like, why think about it over the weekend? Because I guarantee you on Sunday when I log into my account, and then so pretty much I log into my account and then I look at all the positions that I have to like pay attention to. So usually it's like 10% of like the positions that I have. Like, okay, so the Apple, like a few PayPal positions, that's pretty much it, right? Mm-hmm. And then I pretty much ignore everything else until it hits. It's like buy to close, and then it automatically closes or it expires. But yeah, like if it's a small loss and you're like slightly concerned about it, I don't think that that's bad to close it out. I do think that Apple is overbought. I mean, it's pretty. It hit like a new high today. Wasn't it up like $4 today or something?
Yeah, I can't even pull it up. It went up to like 177, something crazy.
Yeah, so yeah, like I am kind of concerned about my trade. So I think like that would be fine. On the positive side though, I think unless it's something like Tesla where it goes up like pretty much all the time, for a stock like Amazon, rolling the call over time, you kind of know that you're going to make money, because these stocks have a tendency just to like staircase up. So I know Apple has gone up a lot, but you probably could have rolled that position by like $5 or $10 and then just hope that next week it would like stagnate. But still, for like a loss of like $40 or $50, you can make that back elsewhere. It's probably not even worth your mental space. It's not worth the stress.
Yeah, looking at it now, the bid and ask, 390 to 475. By holding on to that, I would have almost doubled my almost 100% loss on that.
Yeah.
Yeah, that would have sucked. Yeah, that's why I was thinking about that, because hopefully Apple is overbought. It does pull back, because I would actually just want to grab some more. But at the same time, it's just been on such a run that I'm just like, what if it doesn't? And that what if scenario, I don't.
So what did it? You were short the 175?
Yeah, collected $1.60 on it.
Yeah, you probably could have rolled that out to like 185 or like 187.5, something like that, by rolling, if you had rolled it like today at 1 or 2. Maybe not. It depends. Like if Apple went up a lot, like the last hour of the day, and I know that the market was up like pretty much. It was up a lot like the last like 2 hours. But it depends like when you rolled it. But the good thing about waiting to roll is that there's no more time value left on the option if you roll at the day of expiration. So you probably at some time today, you probably could have rolled that 175 all the way up to like 185 just by extending the duration by 1 week.
Yeah. Yeah, I could have. And
But
then
it was a good trade to close it out.
at what point, because you can't roll forever.
Why not?
What if you just run out of gear? Like you just, I wish I had a specific scenario because I wanted to ask you this. I forget the premium just wasn't there anymore, and there was a guy asking me what he should do, which I don't ever give financial advice, but he just couldn't sell any strike to collect to make up for the loss he was in, and he basically just ran out of premium, ran out of strike.
Yeah. So in that situation, let's say you sell like a really like crappy stock and then there's kind of like no hope for it, then I would just like close it out. But if you're trading a stock that has like a strong brand, then like I pretty much believe that most of the stocks are going to rebound. So for example, like let's say PayPal drops to like 150, I'm not going to close out the position because I believe that I'll be able to make money from it and that eventually it'll go back up and I can still sell premium around it. However, if you engage in like a risky trade, like similar to the trade that you did, where you go in recognizing like, hey, this is a high risk trade, and then it becomes so far in the money where you believe that it's kind of like a fish out of water, then in that situation, like, yeah, you can't really sell premium on it anymore because you're only picking up like a few cents. So yeah, just close it out.
Yeah. I guess let's talk about this. Sometimes you just got to close out a position.
Oh yeah, for sure.
Like,
hey, that's 100% true. Like I had so in March 2020, I sold like Lockheed Martin, which is, hey, that's like a big company. I think it almost has a market cap of like $100 billion. It has like government contracts, and I was like so stressed out because it was showing me a decent loss. I was like, yeah, I just don't want to deal with this anymore. So I closed it out, and then, yeah, I took the loss. I mean, it is what it is. I think that guarding your mental health and reducing stress is probably the best way to be a long-term profitable trader and to be consistent and to be trading 10, 20, 30 years from now. If you're kind of addicted to the dopamine hits, whether it be the ups or the downs, I think that you're eventually going to find something else to do, and you're not going to have staying power.
Nice. That's exactly how I feel. Like, and I tell everybody, like, just imagine stopping out and closing that position, and then watch those red candles continue to come. There will never be a better feeling. Like, you'll feel like you just made all that money because you're not still sitting in that. But people just have this, I can't separate from a position. And I don't know. I wish I knew what really drove that, other than separation anxiety. Like it's a hit to their ego or what. But it's just the long-lasting effects of just watching that thing drain you, your account, your mentality, like everything just destroys you.
And I don't get it. Like, to people who watch this, do they think that we don't want to make money? Like, no, we want to make as much money as possible. Like, do we feel like leaving money on the table and being like, oh no, like we're not doing this and we're not being conservative in order to be benevolent. We're doing it because we've had our ass handed to us a few times, and we recognize and remember the pain that we felt, and we do not want to experience that again.
Yeah, exactly. Because something I preach a lot. My father says all the time, it's 3 or 4 letters. Like, just find another 3 or 4 letters, like the ones that are going up, like the good ones. So like, you don't have to just, why are you so tied to these one things? Just lose it. Every morning you make the conscious decision to say, I'm down in this one. And whether you had 100 grand, it's down to 10 grand. That doesn't matter. That's what I hate, that it's not a loss till you lock it in. Like that's a loss. You just haven't locked it in yet. You have 10 grand tied to that 3 or 4 letters, and you're consciously making the decision that today I'm going to keep that 10 grand in there, not apply that 10 grand into a different ticker that would go up. They get on this, and I hate this, and I guess we could probably wrap it up here. Just I got to make my money back mentality. Like, what trade are you ever getting in to not make money in the first place? Like, what do you mean make it back? Like, you're here to make money regardless. That one didn't. Find a different one.
Honestly, I think I need to do a better job at that too. to be honest. I really think so. I think, like for example, Zillow was like cut in half. It was trading at like 104, and then just like 3 weeks later, it traded down to like 52, and now it's trading like around 60. And I was like, so I traded it very small, but I lost money on that position, and I just rolled it forward in time by like 5 months, and I was like, all right, I'm just gonna sell premium around it. So I've been selling like some 40 puts, selling some like 75, 80 calls, but I don't want to hold that position. And eventually what will likely happen is that like 3 or 4 months from now, I'll eventually like make back all that money. But it's an ego thing. And if I took that money and I deployed it into something else, although I will say though that it is like a good learning experience, but for someone who like, for someone like myself, where I do have like a lot of experience like rolling and managing trades, I'm not really learning anything. It's more just like an ego thing. Like, no, I don't want to lose money on this trade. So I think I should, if I was smart and like more disciplined myself, I would actually like close it out and be like, hey, like, okay, so I'm down like $3,000 in this. You know what? I'm just going to close this out and then sell like, 600 naked puts on Tesla. And if I did that for like 2 weeks, I would make that money back. Yeah. So why should I hold a position for like 5 or 6 months? So I do think that there's like a psychological, it's like that whole, what do they call it? The endowment effect, where like you buy something and then you don't want to sell it for the price that you bought it, or even for like a penny more. Like you only, the second you own something, you feel that it's like more valuable. So I think it might have like a little bit something like that. But yeah, I could actually improve with that as well.
Well, I mean, I've done stuff like that. No, I don't think anyone's impervious to it. I think just the more experienced have seen enough of it that they're just like, I know I've read this book before, let's just depart, just, there was something I was just getting ready to touch on. Oh, yeah. When people don't do this, and maybe this can help some of your followers, because I've said this 1,000 times on my channel. If you're not willing to cut losses, some people will just bag hold until it's green. That is literally you coming to the table and saying, I'm going to have 100% track record. Like, I'm going to be the one trader in the world that never takes a loss ever. Like, it doesn't exist, because you just, sometimes things don't come back, or it's just, eventually just not worth it, and you just won't be in the game. By the time it does come back, you're not going to be around. Like, if you bought, what was the not one company, the .com, not Corsair, and it's not IBM, .com crash, and obviously .com crash, it tanks, loses most of its value. A lot of them came crawling back up. This one still hasn't hit the highs from the .com. And then just imagine that's the one you're bag holding forever. You're just pinned in that for over 20 years, and you're just now getting back to break even. Like,
I mean, I think that's kind of, it's probably like a little bit extreme. Like, I mean, our follow, I mean, a lot of our followers, like you were saying earlier, that they want to hit like 20 or 30% in a month. I highly doubt that they're going to hold on to a stock for like 20 years. I do think that there is definitely a lot of opportunity cost holding on to losers, not only in the money that you're holding in the stock that you're not able to deploy into better underlyings, but also the psychological effect. I also think, though, that if you have like a stock that you believe is going to go up, which is why when we first started talking, I asked you about like that $5 stock that you sold and you collected like 45 cents. I explicitly asked you, like, what's your gut feeling on the stock? Is it like a fish out of water, or do you think it's going to go up? And if you think that it's like a dead stock, then in that case, like, I would get rid of it ASAP. But if it's a stock like PayPal, or even something like Zillow, which has like a pretty strong brand, and you're like, hey, like maybe the market is overreacting a little bit here, and I can still collect premium, let me give it like a few months, and I'll try to make it back. I think that's okay, like as long as your position is small and you protect the downside. So if you're long some puts, where even if the stock goes against you, then it's okay. then I think that that's okay. But you don't want to like get like one-itis or something like like when I read that game from Neil, that book from Neil whatever, Neil Stroud, Neil whatever. You don't want to get like too infatuated with like one stock.
Yeah. Oh, some of my followers need to hear that. They are in love with one ticker. It's not the best right now, and maybe in the future it might be. There's worse ones out there, but yeah, because I do recommend, partly with me being a price action trader, like just being a master of a few, which is not just one. I think that there is a detriment to just only being focused on one, because sometimes the trade isn't there and you're just stuck there. But me being in there was ticker B big. Me being in that is more of a fish out of the water, because my bread and butter are Tesla, Amazon, Facebook, Nvidia, AMD. Like, if worst comes to worst and I were to bag hold those, I'm probably just red until they do turn green. And it's easier said than done. So I don't like saying this on YouTube, but I like to buy things that are going up. It's just not. It's not a hard position to be in. And with the days that they are red, you get some management questions like, should I be in this? Is there more downside? If I'm going to hold this, how long am I going to give it? Not, is this going to come back to life? I'm never asking, is this going to need CPR? Like, is this going to get delisted?
I agree with you 1,000%. And I actually sold puts in Nvidia today as well. I think that there's a huge difference between seizing an opportunity like you did with BBIG and saying, okay, I can collect 8% of the total of the strike price, or less, or about 8% of where the current market price is, versus selling like a 550 put on Nvidia, having it correct by about 10%. In that case, you might actually want to get a sign, because you're like, hey, like, I believe in Nvidia. Like, it's gone up. So Nvidia has been one of the strongest performers over the past year or two. So if you can pick it up at like a 15-20% discount to its 52-week high, and then you can own it and maybe sell some like out of the money calls and pick up some additional premium, I think that would be an amazing cornerstone to your portfolio if you wanted to be long equity. Like, you pick some Apple like at like 150. You pick up Amazon at like 3,000 if you wanted to sell a 3,000 put. Like why not? But that's way different than like a speculative stock where you're kind of just like hoping that it becomes the next meme stock.
Yeah. There's a reason everybody's talking about GameStop, because it's the one that actually went up. Everybody wants their ticker to do that. There's a reason everybody knows. Out of over 7,000 tickers, there's a reason why everybody knows GameStop, because that's how rare that was. But I do have a friend, he put it perfectly. When you're selling naked puts like that, it's getting paid to put a limit order out there. Like, if you want it there and you're willing to buy it right there, then even, cash secured put, you're going to tie up capital, obviously. But yeah, if you're asking me, like, would I buy Apple at 150 right now? Yeah, I would. So I'd have zero problem selling the 150 Apple puts. I'd collect money, and if it got assigned, so what? I was going to click the buy button if it got there anyway. So now I'm just going to collect some change on top of it.
A few interesting things about GameStop. I think that it's been relatively stable recently, because even though I don't really follow it, I remember hearing that the implied volatility rank, which means like the volatility when you judge it and you compare it against itself, like over the past year, it's only at like 5%, meaning that the volatility right now in GameStop is incredibly low relative to where it's been over the past year. The second thing, which I'm really shocked about, is I could have sworn that GameStop was going to be like a 1 month or maximum 2 month situation, that it would drop to about like $20 or $30, but it's still over 150. I mean, I'm shocked that it's been able to maintain its gains like that, and I'm very, very surprised.
I got a tinfoil hat theory for that. And obviously I can't prove it, but some institutions that were in that got reamed. Like, they were on the phone with their broker. They were just in a bad spot. They thought it was the next blockbuster. They're selling calls, and then here it is. And everybody got so excited about that, and they're just not paying it. They don't know. A lot of these people that are in GameStop have no idea how institutions actually work. But if an institution could just pin it right there, and then sell all the calls and puts against it and just leave it sideways. Because they had YouTubers on mainstream media on the news talking about it. Like, yeah, you get all the let retail cover your margin call. Like, that's the only thing that makes sense as far as, or everybody's just holding this thing forever because they think it's going to be, even if GameStop turns things around, I don't think it's $150 ticker.
No, it doesn't.
Yeah, so that's why, like, the only thing that made sense to me was we just keep it right there and sell all the puts and calls against it and let the retail traders cover that margin call. What do you think? How far off the wall does that sound?
I don't know. I don't really follow it. I don't really I don't know. I mean, hey, I will say that a lot of retail traders are now trading options. Like the option volume, it has picked up significantly over the past 5 years, because of the leverage, and you have a lot of traders who are selling and buying options as well. So I don't think it's just like sophisticated hedge funds who are selling or buying options. My gut feeling is a lot of hedge funds, like, they got crushed in GameStop, and remember that they usually have to put out like a quarterly letter to their investors. So if they took like a large loss, I think that they would probably validate it and justify it and want to like save face. And I think some of their like either the institutional or high net worth clients, they might not feel comfortable with their fund like holding GameStop, especially if it showed them a major loss like a year ago. I really don't know. I'm not informed that well or educated on that.
Yeah. I mean, I can't prove it. That's just kind of my thesis on, or me trying to validate why I get why it pushed up, but then just staying there. Why was that not a pump and dump?
But I'm very similar to you. Like I really look at price action, and I just figure that almost everything is going to be priced in. And hey, with GameStop, it doesn't have a large market cap, but there was so much media attention that I do think that it's pretty fairly priced. I mean, it can't not be priced accurately when you have all this attention on it.
True.
And so much volume.
Yeah. I can't agree with that. I mean, I do say our markets are incredibly efficient. With technology these days, everybody knows everything, which is why I don't really care for news, which some people, they just can't wrap their heads around that. But like, if you bring a piece of news to me, if it's not insider information and I'm not literally the first person finding out, I assume that's probably already the people that wanted to make money off that news, that put that news out there, probably already has their position in, and they're already managing what they have versus trying to speculate on the news, chasing it after. I think a lot of people fall for that mouse and cheese trap.
Yeah, I mean, unless you know about like an FDA approval beforehand, and it's like a biotech stock, which I don't really trade. Like, I don't look at any of the news, which is I don't think it's valuable.
Yeah, I 100% agree there.
I mean, look at all right, think about it this way, right? So Alibaba hit like 110, and then I think it was Thursday, they said that like that company, that Evergrande or that Chinese company, defaulted, and then Alibaba was up like $10, right? Like, that doesn't make sense. Like, when I first read the headline first, and I was like, oh, I wonder what Alibaba is trading at. I thought it was going to be down like 25 or $30, and then it was up $10. Like, it's like really, really hard to predict price movements based upon the news. You're better off just studying price action and then reacting based off the price action.
Yeah, I agree. My go-to example is everybody knows about this chip shortage. Everybody, and it's slowing down auto manufacturers. And then I just tell them to pull up AMD, Nvidia, Ford, pull up anybody involved in a chip right now, and you'd think their stock is just knocking on the door to zero, going to the OTC market, but they're all up, just up and away. Like, if you followed the news and you thought chip shortage, they can't manufacture them enough, that's just bearish. That sounds bearish, but everything is just green across the board on that.
Yep.
So let's wrap it up here. I know this is going on both our channels, so tell everybody again where you're at, where to find you.
Sure. So My channel is youtube.com/beststockstrategy. And if you do have interest, you can visit my website, beststockstrategy.com, and enter in your email to receive $400 of valuable free training about options trading. And yeah, I have like an alerts product, which if you have interest in following my trades, it's like $19 for 7 days. And yeah, the website is beststockstrategy.com, and yourself as well for my viewers.
So Don Francho, there's no spaces. Just like all the other YouTubers, I have the course, the mentorship, like that's all down below. Just like anybody else. But I would just encourage, come watch my live streams. I go live Sunday after the futures open, and then Wednesday night. Come check that out, and subscribing's free. That's it.
Awesome.
So. Also, I'll put there's a for my viewers, there's a link to your YouTube channel. I'll put that in the description, so it'd be easy to find.
Awesome. Yeah, I'll do the same as well.
Sweet, man.
Thank you so much. I really appreciated the time.
Of course, man. Yeah, let's do this again.